Here's how I've taken a mortgage from $44,000 per month to $21,000 a month by making this one very small change. I have an asset that's got a mortgage on it of $3.85 million. Now, I settled this loan around about 12 months ago, and at the time of settlement, the valuation come back lower than what I paid for the asset. So I could not go with a major lender due to some policy, and I had to go with a non-bank lender because of the way they were going to structure the loan. Essentially, part of the debt was going to be held on the asset itself or securitized by the asset, and then part of the debt was going to be securitized by my trading entity. Because of that reason, the rate on that debt was 9.95%. And there was a portion of the debt that had to be paid down, or the capital had to be paid down, principal and interest, due to the way that loan's structured. With the non-bank lender, the debt was costing $44,000 per month. I wasn't able to refinance it to a major lender until the new financial year rolled around. So we had new financials to use, obviously, so we could show more serviceability. And I had to make improvements to the asset, of which I've done, to then increase the valuation so we can then get the valuation we needed. So that is what I've worked on over the past 12 months. We've been paying this $44,000 a month in interest per month, which is obviously excessively high. Now we've refinanced this debt to a major lender, and the change has been huge. So we've got the same $3.85 million of debt. We've changed 60% of the loan to interest only, and 10% of it is P&I, because we're going to pay the loan to value ratio down from 70% to 60%. But the 60% is going to be on interest only, and only the 10% that we're paying down is going to be P&I. Now what that means is we've got two loan repayments, one of $15,000 a month, which is the 60%, and then the other one is about $6,000. So combined, we've got a $21,000 mortgage on the same amount of debt in comparison to $44,000 per month, which means the repayments have more than halved. The reason this has happened, and the reason we've brought the mortgage down so much, is because the rate on this is just under 6% in comparison to just under 10%. The way that we've structured the loan, being a split loan of 60% interest only and only 10% principal and interest, is a commercial loan, not a residential loan, means that we're paying interest only on a big chunk of it and only having to pay down the principal on a small portion of it. But just with this very simple restructure from a non-bank lender to a major lender, the repayments have more than halved. But the key takeaways here are, we couldn't settle the loan originally with a major lender, so we had to settle with a non-bank. I didn't get caught up on this number when I settled the loan because I knew it would only be for a short period of time and I really wanted the asset. So we paid this for a short period of time. As soon as we could refinance it, we've then gone to a major lender, refinanced it down to $21,000 a month. And now moving forward, the debt's with a major lender, the assets with a major lender, and our repayments will be significantly lower. But if I didn't have the non-bank lender to begin with, I would never have been able to buy the asset. So the key here is, don't get caught up on short-term numbers. If it is a little bit more expensive, if you're buying the right asset, because as soon as you can refinance it to a major lender on better terms, you do. And the difference is dramatic.